Clara Hermit and this is Breaking the Mould, our regular look at the financial markets with investment director Russ Mould. Russ, how are you doing?
Very well, Clara. How are you?
Not too bad.
Good, lovely
at all.
to see you again.
I think summer has left us.
I fear so. There's an autumnal twang in the air, I'm afraid to say.
We are, however, here to stay. Russ, what's the fuss?
Okay, we're not here to talk about the weather, and there is a batch of very lively corporate reports due out. Retailer Kingfisher, trading update from online grocer Ocado on Tuesday the 15th, trading update from FTSE 100 newbie Merlin on Friday the 18th. But I suspect that all of this is going to be completely drowned out by the latest meeting of the US Federal Reserve, scheduled for the 16th and 17th. I think that's going to cause all the fuss.
And that's where the fuss is going to be. Okay, so we will be talking about the central banks a lot, but what's particularly important about the latest decision from the Fed?
Yeah, we do talk about them, some might say bang on about them unnecessarily, but interest rates are important for share prices in three ways. First, higher returns on cash can tempt investors to take their money out of equities and put it in the bank, because there's a higher return available there. Second, bond yields tend to go higher, again persuading investors to seek higher returns from instruments which are ultimately relatively less risky than stocks. And third, this is a bit technical, interest rates are a key part of the discounted cash flow, or DCF calculation, which is fundamental to long-term equity valuations. In simple terms, the higher the rate, the lower the valuation, and vice versa. Here endeth the lesson. Now, this chart shows the Fed funds rate and America's S&P 500 index all the way back to 1990. Now, as we can see, headline US rates have been anchored at a record low for 6 years, and that's been great for share prices. Low returns on cash, low bond yields have pushed investors towards equity in search of some sort of decent return on their money. So the question, of course, now is, what happens if the Federal Reserve does increase interest rates next week, first time since 2006? Well, we've got history as a guide, though of course that offers no guarantee. Our analysis of 7 cycles of higher rates and 8 lower ones in the US since 1971 shows that US equities do perform better when the Fed is loosening and rates are going down. But the results during periods of tightening and higher rates aren't awful. Our research shows during a cycle of lower rates, the S&P 500 rises by an average of 19.9% from the first cut to the last. And during a cycle of higher rates, it still goes up by an average of around 10.3% from the first hike to the last.
Okay, Russ, so that is, of course, America.
Yeah.
I want to know what everyone's worried about.
Okay, well, it doesn't sound too bad, does it? Up 10 compared to up 19. Yes, it's not as good. But those averages do contain a very wide range of performance across the 7 rate cycles, as you can see here. Now, in addition, the next graphic shows the average performance of the S&P 500 before and after the first rate hike of a new cycle. And it does it by time period. 12, 6, and 3 months before, and 3, 6, 12, and 24 months after. Now, as you can see, the period in the middle, Jeffrey Boycott's corridor of uncertainty outside off stump, is when we get the choppiest market performance, and that's where we are now, when we may be coming up to and coming out of the first rate hike.
Okay, so what does the US stocks have to do with us here in the UK?
Yeah, I mean, I've banged on about the US, and obviously we're all sat here in the UK. Most of you people out there will be invested in UK equities rather than US ones. The fifth and final chart answers that. It shows the S&P 500 against our own FTSE All Share over the last 20 years. And as you can see, there's a pretty close correlation, though again, past performance is no guarantee for the future, but generally with a go US stocks, UK stocks tend to follow.
So, do you think the Fed will act next week? And if they do, will the Bank of England follow?
Very good questions. With US GDP growth in Q2 of 3.7%, unemployment of only 5.1%, core inflation of around 1.5 to 2, it'd normally be an absolute racing cert that the Fed would act and raise rates. But still a lot of debt in the US economy. A rate rise could send the dollar soaring, and that could actually hurt the US economy in terms of its exports. And I think the Fed is still very wary of financial market volatility, even though it shouldn't be, given that one of the aims of QE was to boost stock prices and create a wealth effect. They'll be a little bit wary of interfering with that. The market seems to think there's about a 1 in 3 chance of a US rate rise next Thursday, so let's see. And personally, can't see the Bank of England moving until until the Federal Reserve does. Now, one final point, if I can, really quickly. History shows that real market accidents, i.e. big downturns, have tended to occur when interest rates have gone up, but only at a time when also corporate earnings have begun to disappoint and the economy has slowed or even gone into recession. Plus, valuations are at very high levels. So you really need three things to happen all at once. So interest rates aren't the be-all and end-all. Do keep a look at those other issues as well.
Okay, thank you, Russ.
Thank you.
And thank you to you for joining us. We'll see you next time. Goodbye.